Hello and welcome to the Rask Network. What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information.
Pete Wargent, welcome to episode 2 on this in this mini-series on the Australian Property Podcast.
It's good to be back.
Today, we are obviously celebrating your new book with Cate. There is a link in the show notes for anyone that wants to pick that up. In the first episode, we talked about foundations of property. We touched on a few really important points around, your personality and market cycles and these types of things. Even though we said foundations, it's not necessarily only for beginners. So if you haven't listened to that episode, I would highly, highly encourage you to go back and check that out. You don't need to have listened to that in order to enjoy this one, though. So people can pick up the book on Amazon. Again, there is a link in the show notes. We're going to start off with a few icebreakers before jumping into this concept of a powerhouse portfolio, which really stood out to me in the book, and then maybe talk about a few other things like leverage or financing, I should say, and what the future might hold for property investors in terms of like tools and resources that they can use. So for icebreakers, I thought I'd ask maybe what is the number one reason that you think people lose money in property?
Number one reason, I think it's just not having a plan. I think if you fail to plan, then what's the phrase? If you fail to plan, you have a plan to fail, whatever it is. But that's basically it. I think if you do your research and you have a strategy and a plan, then everything else falls into place. If you don't, then you tend to sell too soon, or you buy an off-the-plan apartment and lose money. So it's really, it's preparation, I guess.
Yeah, like it. Number 2 is which investor has influenced you? I was going to say the most, but if I just say which investor has influenced you, it doesn't have to be in property. It could be in business, stocks. It could be an author. It could be someone, personally, professionally, whatever. Just someone that has influenced you.
Oh, can I give a few rather than just one? Look, I think it's a cliche, and I've no doubt said this on other podcasts, but I think in terms of actually getting me off my backside and starting, it was my wife, Heather, who got me, and she really tilted me from stocks to property. So I think by far the most influence would be her. I guess in terms of strategy, I guess there'd be 2 people, Michael Yardney and Jan Summers. If you go back, some of her books, it's a long time since they were written. I wouldn't even like to say how long ago, but a couple of Jan Summers' books were just absolute timeless classics. And even though some of the specifics have changed, like the principles of those books are absolutely, just completely groundbreaking at the time. So for property investors, I think in the stock market, probably Motivated Money, Peter Thornhill. That just kind of resonated. You don't have to follow somebody's blueprint exactly, but just in terms of taking the long-term view, and you can tweak the strategies. These days it's easier to invest globally, for example, than it used to be. But like the principles, for me, that was just a big eye opener. And then in business, probably Taki Moore, if anyone's followed his coaching stuff. There's loads of free YouTube content. Check that out. It's just really good stuff. And he's just a natural communicator.
I was just looking up the Jan Summers book. So late 90s, early 2000s, a lot of those come out. All of those references are spot on. The Motivated Money book, Peter Thornhill, listed investment companies, if I remember correctly, were a big focus for stock market investors, getting passive income. So before people talked about financial independence or FIRE or these types of things, he was focused on, how do you just get income? How do you grow a portfolio that can provide for you? And
and it was the long-term focus. And look, some of the specifics for these things do change over time, potentially. It's easier these days to invest internationally, for example, but the principles are absolutely bang on. Also, so Building Wealth Through Investment Property, Jan Summers, and then I think she had a follow-up book, which was something like How to Thrive, Not Just Survive in Property. And they're just absolute belters, really good reads. And for sure, the prices probably look small when you put them in today's dollars, but it's just the principles were so good.
Well, if you read for knowledge, I think it's the principles that rarely change. Maybe it's the application that does. And I think that's the key to defining feature. When I read, I got asked this the other day. I said, I don't read for entertainment. I try to, but I don't. I read for knowledge. And the thing that I find is what gives me great comfort, especially during times of uncertainty, is reading things that weren't written today, reading things that were written 10, 20, or 100 or 200 years ago, and seeing that a lot of the things that have played out in the past are playing out now. How did they cope? What can I take from that? I think it's chapter 9, Pete, in the book. You've got this idea of building a powerhouse portfolio. I wanted to ask you, we mentioned it before, how people lose money. Before we get to the really juicy stuff, which is like, what is a powerhouse portfolio? I thought I'd take a bit of Charlie Munger out and get him on the podcast, the late Charlie Munger, and ask you, what's a mistake that you've personally made in property? Like, what's one thing that you can immediately think of when I say a mistake that you've made?
Oh, look, I've made all the mistakes in one sense, because I think we were chatting before we started recording. When I started out, like I was somebody who worked in professional services, chartered accountant. So, and especially as a young man, this is pretty common, right? You think you know everything. And yet when I look back, there's so many things that I did wrong. I didn't know how to negotiate well. I bought properties where I ended up with special levies. And I've had tenant issues. Like, there's no end of things that I've done wrong. But look, most of them aren't sort of deal breaking, if you see what I mean. Like, the property market is quite forgiving over time. I think the thing I've done best is just take a long term view, and I've not sold. But yeah, in terms of actual mistakes, lots. I think the single biggest difference I could have made would be not delaying, buying sooner. Not overthinking things too much sometimes. I think you're often sort of trying to find the perfect time and the perfect investment. But when you zoom out, I think that the thing that's probably cost me the most is just being inaction at times, and not using the opportunity to buy when I could have, and so on. So yeah, look, I've made in terms of the micro, I've made almost every mistake you can imagine, which is part of what sort of, that's the apprenticeship that allows you to go on and become a buyer's agent in time. But but at the macro level, probably just not buying sooner, I guess.
Yeah, that makes sense. Now let's take the affirmative and talk about this idea of a powerhouse portfolio. It's in chapter 9 of the book for anyone that's interested or has the book already. You talk about removing the emotions from the property investing process, because as we spoke about in the first episode, it's obviously trying. At any one time, you can open up, a web browser, and if you search for this stuff before, you'll probably find it's at the top of your feed already. It's like the negativity around property, the negativity around the economy. Just there's always something negative. And at the same time, there's also a lot of euphoria that comes with property investing too. But you say that there are a few things that you can do and you can focus on. And I'm hoping we can maybe talk through these. The first was buying quality assets that you never need to sell. Checking prices infrequently was number 2. Thinking of investments as great assets and businesses was 3. And reading classic investment books was number 4. Take these any way you like, mate. But as a kind of checklist for building this powerhouse portfolio, how do they fit in?
Yeah, so this is about removing the emotions out of investing and adopting a longer term view. So buying quality assets that you never need to sell. I mean, what does that mean? I guess generally, when you think of residential property, you probably want to buy something where the land to asset ratio is at least 50%. So if you think about, let's say you buy something way out on the city fringe where nobody wants to live, and the land value's, let's say 50K, and the property, the house is worth a few hundred. Well, that you're just buying bricks and mortar there. There is no land value and there's no scarcity in the product. Generally, when people talk about quality, and you'll hear Chris talk about this more so than me on the Australian property podcast, but you're really looking for investments where the land component is at least half of the value. Because if you think about the old adage that land appreciates and buildings depreciate, I mean, you can argue about the semantics of it, but it's the land value that does the heavy lifting for you over the long term. So quality assets, landlocked investments. If you can afford capital cities, that tends to be good, or growing regional economies where there's a strong and diversified economy locally. So if you can buy quality assets you never need to sell, that's a massive help, because if you're going to be a long-term investor, but almost by definition, you're going to get booms, busts, recessions, more booms. You're going to come across every part of the market cycle. So yeah, and some diversification obviously helps too. So checking prices in frequently. Well, look, the internet has made it easy, in fact, too easy, to spend all of your time looking at comparable prices, reading market commentary. I think we talked in episode 1 about just trying to switch the market or background noise, turn the volume down a bit and try to use different timeframes to review your performance. An annual review would be fine for your property portfolio. You don't need to be checking property articles every day, every week. It's quite common, actually. If I get a client and we buy them an investment property, that after a month, they'll send you an article saying, oh, this guy's saying, the market's going to, do this or do that. And it's like, well, yeah, but you really need to zoom out, because 1 month is not an appropriate time horizon for a property investment. You need to be thinking years or decades, ideally. So yeah, checking prices less frequently is good. Thinking of investments as great assets and businesses. I mean, I guess this is the thing, because prices will always fluctuate and sentiment does. But if you can think of your portfolio in terms of quality rather than in terms of dollar terms, and maybe focus on some other metrics. For example, the rental income, are the rents going up? What's the local economy doing? That kind of thing. And yeah, we already sort of touched on the idea of reading classic investment books, because it can be quite reassuring, because although the specifics change, the fundamentals of successful investing, being rational, that kind of thing, that tends to remain constant over time. And reading some of the classics is a great way to remind yourself. Now, yeah, we mentioned in property things like Jan Summers' books. Michael Yardney's written a couple of cracking books. How to Grow a Multi-Million-Dollar Portfolio is one of the best. I think that's into its 4th, 5th edition. Absolute classic. And it's not just not just in property. My favorite investment book ever, I think, is a really short one called The Warren Buffett Portfolio by Robert Hagstrom. I just love that book. It's just so well thought out, really clear. And as you said, you just look back at the numbers and just go, wow, that just makes perfect sense to me. So yeah, you can find your own favorites, but reading some of the classics really helps too.
Hagstrom wrote one of my favorite books, which was Investing: The Last Liberal Art, which talks about Charlie Munger's approach. So Warren Buffett and Charlie Munger obviously being investing partners for decades. It talks about his mental models and how you can apply all the different disciplines of life, like biology, sociology, to investing. So Hagstrom, Professor Hagstrom is a great follow. If you are familiar with the work, you'll know what we're talking about.
Yeah, those mental models, the Charlie Munger stuff, you could probably find on YouTube, Munger's top 25 mental models. So that stuff is just absolute gold. If you, and not just for property, if you're in business or just in life in general, just so many different ways to think about the world. And it just makes it all sound so logical and so rational. It's if you can't learn something from that, you're doing something wrong, I think.
Yeah. My favorite investment book ever is actually Charlie Munger's Poor Charlie's Almanac. But it's not, I know that it's quite dense for a lot of people, but.
So I've got the audio book and I keep falling asleep. And then I forget where I've got to, but yeah, there's so much gold in that book. It's, but you need to almost go through with a marker pen, because, there's a lifetime of knowledge there.
Oh yeah. One of the things you mentioned there was kind of focusing on like the long-term and the fundamentals of property. And you might have a client when they come to your buyer's agency, or if you're coaching them, they would come to you and say, hey, Peter, I bought this last month and blah, 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 blah. I just read whoever and whatever. I can relate to that, because on the stock market side of things, I obviously like to invest in quality businesses, use ETFs and these types of things as well. But there was a really interesting study that came out from Boston Consulting Group, and a lot of people may have heard me talk about this or seen me do it in a presentation. But basically what they did is they tracked the best performing stocks in the world. And they took the top 10 best performing stocks over decades. And what they found was that it wasn't until the 5th year that you could actually say statistically that it was the company's performance which drove the stock price. And by the 10th year, it was almost all the company's performance. So meaning that like a lot of people, when they invest in stocks, and I'm sure it's in property, similar behavioral bias here, they looked at things like, price earnings ratios. They looked at those random things, or like sentiment, or they tried charting or technical analysis, mumbo jumbo. And then they let the share price determine if that was a good or bad investment. But the irony is, a lot of people say they're long-term investors, but they don't reach year 5 or 10. And so I found that was really interesting for me, because it reminded me that if I am indeed a long-term investor, the thing that can keep me there is this a good asset? Is this an asset that can grow? Because if it is, then the data suggests that I'm tilting the odds really well and truly in my favor. Now, that was just a side note to this next question, which is, in the book, you talk about this. I think you've got 6 points around it. I won't ask you to remember them all straight off the top of your head, but talking about building a robust portfolio that can withstand market fluctuations and keep growing. You gave the KISS analogy, keep it simple, stupid, let's say. And you talked about these different steps that people can take. Why is that important to you? Why not, you can subscribe to these Facebook groups or whatever, and you can get really complicated database strategies, and you're obviously all over these things. Why is it important to keep it simple like this?
Well, I think I can't even remember, I can't remember the name of the law, but is it the engineering principle? Basically, the more complexity, or the more moving parts there are to a strategy, the greater the chance of something going wrong. So if you're building a rocket ship to fly to the moon, you don't want to over engineer it, because the more moving parts you've got, the more risks there are, in a sense. So I think often particularly with property, you don't necessarily need to make your portfolio plan too clever or make the processes harder than they need to be. Simplify. So I guess, in terms of keeping it simple, what can you do? Well, let's go through them. You could set goals. So, obviously your life plans are going to change over time, but it definitely helps to have an end goal in mind to work towards, because that's like a ship setting off on a voyage. You can adjust course as you go, but if you've got a North Star that you're heading towards, that obviously helps. I think you need to have a plan for all seasons, because every asset class, as we touched on, has summer and winter seasons. And as you said, in the stock market, you can buy an investment, and the next day the market could be down. That's true of every asset class, right? So you do need to have a plan that allows for the fact, if you're going to be in the market for 20, 30 years until retirement, well, there's going to be a recession. So you need to have a plan for all seasons and all parts of the cycle. Diversify. Yeah, I think that's, it's one of the golden rules of investing, but you don't want to have all of your eggs in one basket. And in property, that's a bit harder, because it's a lumpier asset class. But, if you've got investments outside of property, particularly in Australia, superannuation is important. So, maybe that's more sort of a financial planning domain, but not having everything stacked on one investment tends to be a good way to keep your life simple. Have a sort of a clear plan or strategy. So knowing how many properties you might want to or need to invest in to meet your goals. Generally, you want to invest when you can and not get too hung up on the market timing. I mean, obviously, in an ideal world, we'll buy low and sell high as best you can, but generally you'll find in property, the longer you're in the market, the less the timing works, if that makes sense. The less the timing matters, if that makes sense.
Yeah.
And finally, I mean, this just goes back to your Munger point, manage the risks and think rationally and think long-term. So you invest, don't gamble, and take a long-term view. And the older I get, the more time I spend now just trying to think rationally. When I started out in investing, very much like a bull at a gate, buy as much as I can as soon as I can. But now it's like, okay, well, I've done the hard work. Now I need to try and think more like a Charlie Munger and just try and be rational.
Yeah, it becomes, as you go on, it becomes more about quality decisions over the quantity of decisions that you've got to make.
100%.
Yeah. I remember an interview with Jeff Bezos. He's like, I don't take any meetings. important meetings after. I think it was like 11:30 or 12 each day, because he's like, my brain is fresh in the morning, and that's the only time I need to make decisions that actually matter. So I'll just do them all then. And outside of those hours, I'm not going to make decisions because I know I'm not going to be at my best. So
did you also say you burst through one-way doors or two-way doors? Two-way doors. Is that an Amazon one?
I believe so.
Like if a decision's reversible, like changing a property manager, fine, do it. Like worst case, they're no good. You get another one. But if you're buying and selling properties, or if you're deciding whether to invest in a trust or your own name, or you don't burst through those decisions because they're important and they're difficult to reverse and expensive. So there's some decisions you can make quickly, but there's others that are much more important to think through before you pull the trigger.
There was a book called Value Investing by Bruce Greenwald. That was one of the really formative books for me in the early days, and it's it just profiles some of the better investors in the world, it at the end of the book, they summarize some of the key themes that they learned from these wonderful investors. And Warren Buffett was one of them, for example, and there was a bunch of others. But basically, the most common theme that they found was that all of the great investors, the first thing they thought about was the downside. And then the second thing they thought about was the return. And I think if we all applied that approach to things we do in life, what's the downside of this decision? What's the downside of changing careers? What's the upside? Like in that order, I think we'll make much better decisions on average. Okay, so I've got a few more questions here for you. One is around so we're kind of like wrapping up the Powerhouse portfolio. We've got that criteria for picking assets. You've walked us through the different steps on how to keep it simple and long-term focused. Normally, when I speak to property investors, like the first thing they tell me is, I bought it at this time and I sold it this many months later or this many years later at this point, and I made this much money. And if you think about that, it basically all says timing. Like the number one thing they're saying is, I timed it well, or sometimes timed it bad. They don't really talk about those as much, but I timed it well. But we're here talking about long-term investing. So how does market timing play into your strategy or the buy-ride approach?
Yeah, I think generally we're talking about taking a long-term view. You can actually see now. I mean, you can do your own research on this. You don't need to take my word for it. But if you look at properties that sold, I was looking at an example of some properties that sold land release in the Northern Beaches in Sydney, up near, I think it was Narrabeen, and they were selling for about £10. In 1922. People were putting down a couple of pounds deposit, and obviously you've got the exchange rate change in the 1960s to account for and so on. But if you actually track it back, the compound annual growth rate has been about 11.5% or something like that. And I think the RBA's got 100 years of data for residential property, about 10%. There's some, when you actually go back, there's decades and decades of figures. There's more reliable data from 1970 that would tell you the median house price in Melbourne in 1970 was about 12k or something like that, and in Sydney about 18. So I think yes, market timing to the extent you can do it is great, but actually the power of time in residential property and land values tends to be more powerful. And look, I've got no end of friends. You see, I'm at my age. I know. People with parents who bought properties in Sydney, like, I don't know, Wentworthville or Bronte, and prices are up 40x. It's the time that does a lot of the heavy lifting for you. Of course, everyone loves the idea of the get rich quick, but I think if you can take a look at some of those long-term stats, it might change your thinking a bit.
I remember when I was starting out investing in shares, a colleague of mine came to me and said, "You're 20 or 30 years younger than me. If I could give you one piece of advice, don't waste time trying to pick the next big thing. Don't waste time trying to find how you can speed up the return. Just find something that's going to be here when you're my age and buy that today." And I think that was such wise advice. Didn't listen to everything he had to say, but I should have, because and I'm now doing that, but it took me about 5 to 10 years to get around to it.
Survivorship. It's such an important thing. If you think about Buffett, he's not going to invest in, I know there was the issue with Salomon Brothers. If you went back, the which in hindsight you might do differently. But if you think about everything that they invest in these days, it's survivorship, and property is good like that because property always prevails over the long run. Yeah, it has ups and downs and good and bad times, but there's almost no property you could have bought 100 years ago that you wouldn't want to own today in Australia. So of course, some do better than others, but yeah, land is pretty much indestructible. So if you buy good locations, the survivorship is definitely a key facet.
There's one other thing here which really stood out to me in the book. I can't remember which chapter it's in, but you talk about, like, we've all heard about like IQ, we've heard about EQ, emotional intelligence, but you talked about this idea of kind of like AQ in the book, and I wanted you to just kind of elaborate on this. I think it was like adversity or adaptability or something like this. Can you talk about what you meant by AQ and how that plays a role in investing?
Yeah, I mean, AQ is really about how you deal with adversity, because the thing is, with property investment, not everything's going to go right. There will always be issues along the way, whether it's tenants, interest rates. You will have periods of high inflation, low inflation. There's going to be times when the market's doing badly. That goes with the territory if you're going to be a long-term investor in the asset class. So I think if I was going to try and sum it up neatly for the podcast, it's like the old Japanese proverb, fall down 7 times, get up 8. That's really what it is, because I've seen this a lot. People will buy an investment, something doesn't quite work out as expected, and they say, well, property's no good, I'm going on to do something else. But before you start, not everything is going to go perfectly. That's just the nature of the asset class. So yeah, a bit of dealing with adversity, that is going to be one part of being a successful investor.
I love, there's so many ways we could take this, and we probably just don't have time, but I love how people respond to crisis or pressure and just observing how they react. And they take, for example, the cliche property spruikers that are on social media or whatever. How do they respond to criticism? How do they respond to the negative reviews that they get? Like, are they honest and upfront? Do they have the ability to rise through adversity and wear the punches and move on? And I think you too, as an individual, I brought up that random anecdote that we were talking about internally the other day about the number of prime ministers, UK prime ministers, that had a parent die before the age of 18. I think if you go back up until 2 decades ago, one third or 2/3 of British prime ministers had a parent die before 18, which is just unbelievable when you think about the numbers. But there it is.
Yeah, and Churchill's dad was, he wrote some brutal letters to him about being a failure. I was listening to Chris Williamson on Modern Wisdom podcast a while back, and you just think, gosh, he was, whatever he did was never going to be good enough for his parent. But I think it goes back to that thing. It's not necessarily what happens to you in life, it's how you respond to it. Because even within the same family, you might get one person that takes a piece of adversity and uses it as motivation to overcome that adversity, and somebody else will give up and say, oh, well, life's not fair. But, it's not necessarily what happens, but it's how you respond to the adverse outcomes, I guess.
Yeah, I love that. So the book, The Buy Right Approach to Property Investing by Pete Wargent and Cate Bakos, is available in all good bookstores, including Dymocks and probably in the airport. I'm going to Sydney in a few days, so I'll have a look in the Sydney airport. It's also available via the link in your podcast player if you're listening on Apple, Spotify, whatever. And if you're on YouTube watching us, hello, you can check out the description below the video, and there is a link there that takes you to Pete and Cate's book. Go and check it out. Mate, I have one final question, which is a bit more of a cliche question. There's so many more that I had, but I'm afraid we've just kind of run out of time. We'll have to do more. Is what advice would you give to someone who is just starting out in property investing? I know we talked about this idea of Powerhouse portfolio, and you mentioned recently that you're kind of in a different phase of your property investing where income's important and all the other things are important. What would you say to people that are listening to this or watching this that are just starting out? Obviously, pick up the book would be number one, but number two, what would that be?
I'd say, think long term, get the snowball rolling, and just choose your data and information sources wisely, because there's there's good and bad out there. Invest for multiple cycles. And I think, just to, I guess, a piece of reassurance for you, really, because there's always going to be ups and downs through the market cycles. But as Australia becomes wealthier, and there are so many things, there's so many sort of tailwinds for Australia in terms of the way the economy works. Most millionaire migrants in the world come to Australia now, massive resources, wealth. As Australia gets wealthier, that wealth gets capitalized into land values. That's just the way it is, rightly or wrongly. So yeah, think long term. And look, there's stacks of stuff we cover in the book that we haven't had time to cover today in terms of planning, getting a good mortgage broker, the financing, keeping buffers, all of that stuff. But yeah, if I was talking to somebody, I would just say, think long term, get that snowball rolling, and you'll thank yourself decades down the track.
Yeah, you will indeed, mate. I know the book's there for people to pick it up, so go and check it out. If you do have any feedback for us, you want us to cover something that maybe Pete talked about in the book or Cate talked about, or if you just want us to dive further into a particular topic, or just get your question on for the next Q&A that we do regularly, don't forget to hit the link in your show notes that says ask a question. You can also use that to give us feedback. Just select the Australian Property Podcast. Pete Wargent, absolute pleasure, mate. Thanks for joining me.
Thanks, mate. And I'll hopefully see you in Melbourne soon. I'll have to get the time shifter app so I don't get any jet lag on the way over.
Don't forget that one, mate. Cheers.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.